Hey guys, it's Willie. Today I want to take a look at Unilever stock, currently trading at 51.30. It is down 2% today, which is a bit odd for such a diversified global conglomerate. Over the past year, they're down 5.5%. Not really looking good as far as stock price for Unilever over the past year. However, I want to take a look at the financials and see if this behemoth of defensive stocks is interesting from a value play. See what kind of return we'll be looking at if we bought it today. So let's investigate, let's look at some financials, crunch some numbers, and see what we can come up with in our spreadsheet. Alright, now that we're in our spreadsheet, let's look at the money coming into the business. Revenue, you're looking at down 1% a year over the past 10 years, which is strange. I expected flat, but not negative growth from Unilever, simply because they're so diversified. Net income is flat. It's been flat for quite some time now. Seeing some really weird jumps going on in here. I initially thought that this would be COVID, but 2018, we wouldn't have known what COVID was yet, so I don't know why that jumped. That would be something to look into as to why net income jumped. But you're seeing flat, basically flat net income. Free cash flow, however, you've seen that go up, so I'm assuming that you're seeing either increased cash flow from operations or you're seeing decreased capital expenditures, because free cash flow is cash flow from operations minus capital expenditures. So either cash flow has to go up or CapEx has gone down. But nonetheless, good job for Unilever to be growing free cash flow at 7% a year over the past 10 years, while net income is flat and revenue is coming down. Shares, something I always like to look at and like to see it coming down, which it is at minus 1% here. Not an aggressive buyback plan. I always like to see a bigger negative number here. I'd always prefer something like, minus 10% a year. That would be fantastic, but minus 1%, I'll take it. Is still increasing our ownership of the business. And it's part of the reason why earnings per share has actually gone up, even though net income has come down. So your earnings per share, you've actually seen a growth rate of 0.9%, basically because of this 1% of shares going down. Even though net income is down, the shares are down. So you're taking a number and dividing it by a lower number of shares, and you're getting a positive growth rate from earnings. Free cash flow, kind of the same thing, but free cash flow is growing at 7%. Shares, 1%, you're getting 8%. So good growth in free cash flow per share. Assets, fairly lean compared to some other companies that we've looked at thus far in terms of assets. Not bad, not something I'm really concerned with here. Dividends are pretty consistently coming up. Again, you're seeing exchange rate issues, kind of like we saw with Honda. You're seeing less so, I would think. The pound and the dollar is more stable. But then again, I'm not a currency guy, so I don't know. But dividends, Unilever is a really good dividend machine. Pretty good growth of the dividend overall. Some wacky times in here where the dividend kind of came down and went up and down, but overall, I think you're seeing a trend upward. 4% growth a year of a dividend. On to the debt. Total debt, $57 billion. Cash right now, $7 billion. Not a whole lot compared to some of the other companies we've looked at. Net debt leaves you, call that $50 billion. Compared to a free cash flow of $9.5 billion, you're looking at, roughly 11 times free cash flow to pay off the net debt. But your assets are higher than your net debt. That's a good sign. But relative to free cash flow, it is a bit high. Return on invested capital, really solid, really surprising to see such really good numbers from a company that sells boring stuff like toilet paper and shampoo. but they are, I mean, you know, a diversified conglomerate. It's very, very rarely do you see these sort of double-digit numbers. At least I wouldn't expect them. PE, current PE looks a bit high. PE, 5-year and price to free cash flow numbers look green, look good. Net debt to the average 5-year free cash flow is 7. To the current year free cash flow, the most recent full year free cash flow, it was about 10. 5-year revenue growth is actually negative, but I'd say that's a low enough percentage. You can call that flat. Earnings growth positive over the past 5 years. Free cash flow 10% a year. Good job. Shares coming down. Good. Return on invested capital definitely above 9% at 19.2. Really impressive coming from Unilever. On to growth rates. Free cash flow and net income are going to be decidedly different. Compared to my other videos, this is strange because usually I project free cash flow to grow at the same rate as net income. However, we have seen with Unilever, it has been a very different story with net income and a very different story with free cash flow over the past 10 years. So I am going to forecast them differently because of this discrepancy in the growth rate of the two financial metrics. So you see free cash flow is growing at 7% a year, growing at 7% a year over the past 10 years. Net income is flat. So I kind of kept the same sort of thing going. I said net income stays flat, free cash flow. I grew it at 5% a year, which is lower than their 7, but they're a big company. Let's make conservative assumptions here. I said 15 multiple. I think that's reasonable given that it's a broad, diversified, defensive company that people would definitely feel safe putting their money into. Based on free cash flow, you're looking at $88. Based on net income, you're looking at $36 in 10 years. Coming over to our current price of $51.50, average or two price targets, you get $62 in 10 years. Onto our IRR calculator, you're in at $51.50. You get these free cash flows. You get $62.14 when you sell it. You're looking at 12% a year. Not bad, but also not great. I'm looking for numbers. I'm looking for numbers bigger than 12%. I'm looking more toward 15. However, I think this sort of company being a solid, stable, defensive company, I think 12% is really good. I think it's a really good value for the kind of company that it is. Compared to other defensive companies, you would expect, I think, less than 10%. Market average, I think you would expect less, since they're small, they're slow growing, large businesses. They're defensive, but they're not growing, and so you're not going to see a whole lot of growth out of that stock price. So yeah, Unilever, I'd say it's fairly valued. If it were to fall much, I might be buying, and depend on how you weight this sort of thing. If you weight the free cash flow forecast, you're going to get a higher number. However, I wanted to balance it out, kind of balance everything, since net income and free cash flow are so different. But an interesting stock nonetheless, a good defensive company to look into. But beyond that, that's really all I have to say about this stock. As always, do your own due diligence, do your own research, run your own numbers, make your own assumptions, do your own calculations, all that stuff that I really shouldn't have to say, but I need to say it anyway. Like, comment, subscribe, all that stuff the algorithm makes me say. And beyond that, I'm going to stop talking right here, right now, and in the video, and I will catch you guys in the next one.